Hello, I'm Parker Gerard with Evolve Advisor Group, and welcome to our Q1 market review. My goal today is to help you better understand what happened in markets over the last quarter and to highlight a few of the key themes that drove performance. We'll walk through results across all major asset classes and sectors, and we'll also discuss the recent market turbulence tied to the conflict in Iran. Before we begin, I'd like to thank our compliance team for the continued support. Looking at performance for the first quarter, all major equity markets ended the quarter lower. US markets declined a little over 4%, while international equities were also slightly down. Fixed income markets were modestly lower as well. On the positive side, commodities were the clear bright spot, driven mainly by higher energy prices. Real estate was another area that held up relatively well during the quarter. When we break things down by sector within US equities, energy was the standout performer. This strength actually began before the Iran conflict, as growing data center demand has been a major driver of energy consumption. Even with the recent market pullback, it's worth noting that 6 of the 11 US equity sectors finished the quarter positive, showing that market leadership was broader than the headlines might suggest. The main storyline for markets in Q1 was the escalation of the conflict involving Iran. Most asset classes got off to a strong start in January and February, but we saw a sharp reversal in March as uncertainty increased. While this initially caused concern for investors, the pullback has so far been relatively short-lived, with markets already rebounding significantly so far in April. One of the biggest impacts from the conflict was in energy markets. Oil prices rose nearly 80% during Q1, briefly reaching over $120 per barrel. This spike raised concerns about inflation, which pushed interest rates higher and added pressure to equity markets. Since then, oil prices have moved back below $100 a barrel, which helps explain why market volatility has eased in recent weeks. It's important to remember that geopolitical events are not new. Since 1940, there have been 44 major geopolitical shocks. In about 73% of those cases, markets were higher just 24 months later. This is a great reminder that while fear can drive short-term volatility, markets have historically been resilient when given time. I always like to wrap up with the stocks for the long run chart. It's a powerful reminder of the importance of staying invested and focusing on the long term. As Jeremy Siegel famously says, stocks are the most volatile asset class in the short run, but the most stable asset class in the long run. That's all I have for today, and I hope this overview was helpful and provided some clarity during a volatile period. And as always, remember, the best plans evolve.